everybody, welcome back to Actual Investing. I found what I believe are 5 of the best ETFs that can add some growth to your portfolio. The other day, I polled my YouTube subscribers and asked if they invest in ETFs, and 2/3 of people do invest in ETFs. I also polled my viewers and asked them what video topics they'd like to see, and the best ETFs for growth was the video topic that got the second highest number of votes. So I figured today I'll talk about 5 ETFs for growth, and even if you don't invest in ETFs, you can always look at the holdings of these ETFs to find individual stocks that you might want to add to your portfolio. So I think this video is useful for you even if you don't invest in ETFs. So with that out of the way, let's just dive right into how I found these ETFs. When I was looking for ETFs to capitalize on growth, I wanted to make sure that these ETFs captured a theme that was going to grow at a compound annual growth rate of around 10% or more over the midterm, so between the next 5 and 10 years. I found this report from Deutsche Bank that talks about their long-term investment themes, and it's really nice. They've kind of segregated them into these 3 categories with some subcategories that they believe are going to do well in the future. So we have the 3 categories being resource transition, population support, and next phase technology. So when I went through and found these 5 ETFs, I tried to make sure that they had exposure to at least one of these 3 areas. In resource transition, we have things like circular material use, sustainable food, and clean energy. For population support, we have infrastructure, healthcare, and consumption megatrends. And for next phase technology, we obviously have things like AI, digitization, and cybersecurity, but also smart mobility. So I think the ETFs I found play on at least one of these themes for each of them. So let's just dive right in and start with the first ETF that I believe is a great ETF to invest in growth, and that would be SMH, the VanEck Semiconductor ETF. This plays on this next phase technology category. Things like artificial intelligence, digitization, smart mobility, and cybersecurity would not be possible without the hardware that powers all of these things, and that hardware is semiconductors. What I like about the VanEck Semiconductor ETF is that it holds lots of different types of semiconductor companies, as well as companies that don't necessarily make semiconductors, but are crucial to the semiconductor manufacturing process. The VanEck Semiconductor ETF has $22.5 billion in assets under management, so this is quite a large fund, especially for a thematic fund, and their expense ratio is on the lower end for a thematic fund at 35 basis points or 0.35%. That means if you hold $1,000 in this ETF, every year you're only paying $3.50 in fees, which is quite negligible, especially when you look at the fact that the fund is up about 46% year to date. Now, of course, that's short-term performance, and the market has also done well, so you would really want to zoom out and look at long-term performance. But for today's purposes, I'm really more interested in the composition of the fund and the management as opposed to the performance, because performance can change all the time, and you can always change the data to make it look better than it actually is, depending on what time frames you use. So let's put that aside for now. VanEck highlights that this fund invests in highly liquid companies, so those are going to be larger companies, companies that have a lot of liquidity, tend to be a bit more stable and a bit less volatile. They also tend to invest in leaders, which is a philosophy that I myself follow in my own investing journey, and they have a global scope, so that means they're not just going to concentrate on US companies, they're going to look all over the world for semiconductor leaders, and I love to see that. All right, let's look into the most exciting part. I do this with every ETF that I look at. Let's see what the fund is holding. I love that ETFs are required to provide their holdings. As an individual stock investor, I love to look at ETFs, find their holdings, and then do some research on them. And sometimes I end up just investing in their holdings instead of investing in their ETF and paying them a fee. So you can't have a semiconductor ETF without NVIDIA, so it makes sense that NVIDIA is their number 1 holding. And then, of course, Taiwan Semiconductor Manufacturing is the largest semiconductor manufacturing fab in the world, so that would make sense to be in the 2nd place. Even though there are some geopolitical risks surrounding that stock, it's still a giant. Then we have some other giants like Broadcom, AMD, and Intel. Broadcom designs semiconductors for, among other things, networking solutions. So they've seen a huge rise in their data center segment. Same thing with AMD, which makes GPUs and other AI accelerators that compete with NVIDIA. Intel also makes these AI accelerators, but is known for CPU or central processing unit chips. And then we have some other ancillary semiconductor equipment companies like ASML and Applied Materials, which supply the equipment that is needed to manufacture semiconductors. And then we have Synopsys and Cadence, which are software companies that provide electronic design automation software, which is vital in designing semiconductors. And then we have semiconductors for other more niche industries, so things like NXPI, Microchip, ST Micro, and on semiconductor primarily make chips for things like electric vehicles and industrial automation. So what I like with the semiconductor ETF from VanEck is that you're getting exposure to not just a AI niche of semiconductors, you're getting exposure to the entire world of semiconductors. So no matter what comes out ahead, this ETF should do well. The other thing that I like is that it only has 26 holdings. Instead of going out and buying every single company that has the word semiconductor in their 10K, they've actually picked semiconductor leaders, and I love to see that. I think this is a wonderful ETF, and if I invested in ETFs, I would probably buy this ETF. The next ETF on this list honestly has a pretty horrible website. They really should get a graphic designer in here to update their website. This thing looks like it's straight out of the early 2000s, don't you think? This is the First Trust Cloud Computing ETF. Ticker is SKYY. To me, this ETF plays on more than just cloud computing. This ETF is very software heavy. And when we look back at that Deutsche Bank report, I think that the cloud computing ETF from First Trust plays on a lot of these themes, but primarily digitization. This fund does have a slightly higher expense ratio at 60 basis points, so you'd be paying $6 a year instead of $350 if you held $1,000 in this fund. So it's a bit on the higher end, and that might not seem like much, but an expense ratio does add up, and just like how investment returns compound, expense ratios also compound because as the fund grows, you have more money in the fund, so they take a larger fee. So that's just something to keep in mind. Even though it seems like a small expense ratio, it's always worth looking at that. The fund has almost $3 billion in assets under management, which is not small, but certainly not huge. So I would say that's still pretty solid. When we look at the holdings, if you're somebody who is bullish on cloud-based software and you're not sure where to start, I think this ETF really gives you exposure to all of the big names. And beyond that, we also have the cloud service providers, so things like Oracle, Microsoft with their Azure, and Amazon with AWS, as well as Google with Google Cloud. And then we also have some other hardware companies in here. We have Pure Storage, Nutanix, HP, NetApp, and Dell. So even though it is software focused, you also do have hardware companies that enable cloud computing. So I think this ETF does a really good job of encapsulating all aspects of cloud computing. What I also like is that you have sort of some legacy names like IBM, as well as some newer players in the cloud computing space like MongoDB, Cloudflare, and GitLab. I'm familiar with almost every single company on this list, and I've done research on many of them. I've even covered a few of them in my YouTube channel. And honestly, I can say that this is a really solid list of holdings. Some of the companies on this list that I either own or used to own would be things like Pure Storage, which makes flash storage hardware as well as data storage software. So it's a bit of a software and hardware play. That's a solid stock that I did end up selling because of their valuation, but I still believe in them long term. We have things like MongoDB, which make database software. We have things like Cloudflare, which specialize in edge computing and content delivery. And of course, Salesforce, which is a major player in cloud computing, along with DigitalOcean, which is kind of like a tiny AWS for small and medium-sized businesses. So honestly, this is a really exciting ETF to me. It's kind of the opposite of that last one, the VanEck Semiconductor ETF, sort of specialized on semiconductor leaders, whereas this one is a bit more diversified. No company makes up more than 5%, and they do have 62 holdings as opposed to 26. So if you were looking for a fund to concentrate their bets on what they have the most conviction in, this would not be the ETF for you. But if you're looking to get broad exposure to cloud computing as a general theme, this definitely would be a solid ETF to look at. The cloud computing market, at least according to this random website I found, is expected to grow at a compound annual growth rate of about 16% in the next 5 years. I fact-checked this against some other research, and they all had the same kind of consensus that cloud computing is going to grow at double digits in the midterm. So I think cloud computing is definitely something to get exposure to. I personally own companies like Salesforce and Cloudflare so that I can get exposure to cloud computing. But I think if you're on the sidelines and you would like to take advantage of some of this growth, the First Trust Cloud Computing ETF SKYY might not be a bad place to look. All right, now we can't talk growth ETFs without talking about the Invesco QQQ. So I won't spend a ton of time here because most of you are probably familiar with this ETF. It tracks the Nasdaq 100, and the Nasdaq 100 is simply a collection of the 100 largest, most actively traded companies on the Nasdaq exchange. So when you buy QQQ, you are not buying the entire Nasdaq, you're buying the Nasdaq 100. Just a quick clarification because some people might not be aware of that. The interesting thing about the Nasdaq 100 is that it actually excludes financials, so you won't get any exposure to banks and things like that. So just so that you know what you're getting into. And it is quite tech heavy. Invesco QQQ charges a 20 basis points expense ratio, so $2 per year for every 1,000 you have invested, and their assets under management are massive. This is one of the largest ETFs out there at $290 billion of assets under management. When we look at their holdings, we see the usual big tech companies: Apple, Microsoft, Nvidia, Amazon, Meta, and Google, aka Alphabet. We also see some of the newer players like Tesla and Broadcom. Interestingly, we also have Costco up here, which is not a tech company, but hey, I don't make the rules, I don't make the benchmark. You can take that up with Nasdaq. Again, like I said, this is going to be a very tech-heavy fund. Information technology as a sector makes up about 52% of the fund. The second largest sector is communications, and I expect that a lot of this is Google, which you could technically consider a tech company. Consumer discretionary would be things like Tesla, which you could also consider a tech company. So I hope you see what I'm getting at, that even though tech as a sector only makes up 52%, the fund is probably mostly tech because some of these quote-unquote tech companies are being recategorized as other things. Next up is a sector that I'm extremely bullish on, and that is cybersecurity. And there are plenty of cybersecurity ETFs out there, but the one that I happen to like the best is BUG, the GlobalX Cybersecurity ETF. That is the ticker, BUG, BUG. Very clever. This is definitely the smallest ETF that we'll talk about today, and their expense ratio is 50 basis points, which is certainly not low. But what I really like about this ETF is the holdings. I think the GlobalX Cybersecurity ETF is definitely the most pure cybersecurity ETF that I've found. The top names that I looked at on this fund are true cybersecurity companies, as opposed to things that just kind of have ancillary cybersecurity exposure. So if you're looking for pure cybersecurity, I really like the BUG ETF. And if you're a single stock investor, I would definitely look at the holdings of this ETF and see if there's anything that appeals to you. Some holdings that I happen to love are Palo Alto Networks, Zscaler, Fortinet, and CrowdStrike. I love those companies. I own two of them, Palo Alto and CrowdStrike. I just bought back in. But Zscaler is a great company, a cloud-based software company that specializes in zero trust security. And then we have Fortinet, which originally specialized in firewalls, but has since broadened their portfolio and are kind of a major cybersecurity player at this point. When we look at all the holdings, we can see that this fund is kind of concentrated like that VanEck Semiconductor ETF. It has 23 stocks, so this is definitely the most concentrated ETF I've seen. And what I like is that it has some of the smaller players in cybersecurity like Qualys and Tenable. So if you don't want to buy just one of the big cybersecurity leaders and you want to look at maybe some of the smaller companies that have slightly better valuations, this might be an ETF for you because you still get exposure to some of those companies. Cybersecurity as an investment theme is expected to grow at a compound annual growth rate of about 9.4% over the next 5 years, so it's just a bit shy of that 10% cutoff I was looking for. However, it definitely plays to this Deutsche Bank report on long-term investment themes. In fact, cybersecurity is explicitly listed here. And finally, we probably have the least mature theme of the ones we talked about today. This is the iShares Automation and Robotics ETF, ticker RBOT. I think a robotics ETF strangely will actually give you exposure to a lot of these things. So robotics could be used in clean energy and sustainable food. It can be used in infrastructure and healthcare, and it also plays on artificial intelligence and smart mobility. So to me, I think robotics is just kind of a no-brainer investment theme. The problem is that there's really not that many great robotics companies trading on the market right now because it is such a new theme. But I think RBOT does a pretty good job of capturing some of the big players. They have a 40 basis points expense ratio, and they have net assets of $3.5 billion. When we look at the top holdings, it's a little bit all over the place because, like I said, there aren't that many great robotics companies out there right now. For example, I don't love the fact that MicroStrategy is a top holding in a robotics ETF. I think that's a bit out of place. But we have companies like Autodesk, which is a computer-aided design software company. And I think Autodesk is going to be a huge player in IoT, or the Internet of Things, which very closely aligns with robotics. Same thing with Rockwell Automation. They sell sensors and automation software for industrial robotics applications. We have Intuitive Surgical, which makes surgical robots. We have Intel, which is a company that's sort of enabling this revolution with their chips. We have ServiceNow, which really has nothing to do with robotics, but has plenty to do with automation. It is automation software. And then we have companies like Garmin, which specialize in GPS, which is also going to be very helpful to the IoT industry. So this is more than just a robotics ETF. It's robotics, it's automation, it's IoT, and more. The holdings are a bit all over the place, but I'm going to give them a pass because, like I said a couple times, there's just not that many great robotics companies, and I imagine as more of them hit the market, this ETF is going to find more of them out there to add to their fund. So Companies that I like in this ETF are going to be things like Autodesk, which I have owned in the past, and Rockwell Automation, which I've also owned in the past, and Intuitive Surgical, which I own right now. I believe it's a bit expensive, but I still really like this company and ServiceNow. So here's a quick summary of the 5 ETFs we talked about. Here's their tickers, their names, the theme that they play on, the expense ratio, and their AUM. If you want to do more research on these ETFs, feel free to screenshot the screen right now, or simply just come back to this video when you want to hear about them. And I hope that this has given you a good starting point if you wanted to add some more growth to your portfolio. If there's any other videos that you'd like to see me make in the future, please leave a suggestion down in the comments below. And if you liked this video, please hit the like button. If you disliked it, please honestly hit the dislike button and tell me how I can improve. Thank you guys so much for watching the video today, and I hope you all have an amazing day.